So just as a reminder, this webinar will be recorded and the slides will be placed online at cap.unl.edu. If you have any questions, feel free to put them in the chat or in the Q&A, and I am happy to address those as we go along. So I think preparing for loan renewal really comes with some physical steps that we've got to do, and that's updating our balance sheet and developing a cash flow for the current production season. So when I talk about renewing loans, what I'm talking about are operating loans or lines of credit. And this is a loan from the bank that's typically used for annual operating expenses and is paid off with farm and range income. Now, there is a little bit of difference between an operating loan and a line of credit. I'm probably going to use the terms interchangeably, but basically what happens is they're kind of shorter term loans traditionally that are paid off as your production is sold. So thinking about that, I think it's important that we're really clarifying exactly what loans that we'll be renewing. So again, I'm going to use these terms interchangeably, probably going to call it an operating loan for most of the day, but I want to make sure that we're clear on exactly what we're discussing today. So just some general discussion of loan renewal. I work with bankers, and I think it's really important that you schedule that appointment early. Maybe you're in a little bit of a tighter position. Maybe you've experienced some drought. Maybe we've had to sell off some cows or do something. Maybe we're still working through some debt. And that really creates this moment where we really need to work with our banker. Bankers are great people. They're on your team. They want to see you succeed. And part of that is working through maybe some more challenging experiences. And if you are in one of those situations, it's likely that you're not the only person within the bank that's experiencing some of those challenges. So again, rather than waiting, I would encourage you to get that appointment scheduled. What do you need to bring with you when you come to this appointment? And we're going to talk about the top two exclusively today or extensively today, and that's the balance sheet and the cash flow statement. But you also will probably need to bring in your most recent income tax returns. Now, this might be difficult. The earlier your appointment is, you might not have your taxes done yet, but they're going to request those anyway. So you might have an earlier appointment and have to bring those back in actually after the loan renewal, but do realize that they'll probably request your tax returns for 2022. And then the most important part is really having a solid plan for the coming year. So again, it's not just, I'm going to plant this many acres. It's this is the kind of debt we're going to pay off, or these are the improvements we're going to do, or, we had to sell off some cows, but we're considering rebuilding this coming year. If you're working with a new lender, you're probably going to need at least 3 years of items 1 through 3. So that balance sheet, cash flow, and income tax return for them. So if you're working with a new person, absolutely schedule that appointment early and be prepared with those items and have past years of those so that they can review them. So today I'm going to be showing you examples of balance sheets and cash flow statements. I have 2 examples. The first one's from Michigan, the second one's from Iowa. Again, these slides will be posted online, so you'll have access. You can click on these links and it'll direct you to the items that I'm going to be showing you today. However, if you're working with a bank, I absolutely recommend that you call them and ask for a template from the bank. They're going to have maybe some things that are just a little bit different. The format's going to be relatively the same of what I'm going to show you, but that way it can kind of plug into their system and it's in a format that they're used to seeing. So number 1 recommendation, if you've never developed these documents before, or you're working with a new lender, that you call that lender and say, okay, here's kind of what I'm looking at. All right, so let's talk about balance sheets. And balance sheets are basically a snapshot of your business at a single point in time. So I have a colleague who likes to say it's kind of like flying a drone over your business and being able to say, this is what my business looks like. And so as we think about that, I like to use the picture analogy. And so basically, if I'm taking this snapshot or this picture, I'm comparing myself from year after year after year. And so it's a really great opportunity to kind of list out what your business looks like. So as we think about that, we're going to develop basically a list. And it's going to be a list of everything your business owns, which we're going to call assets, and everything that your business owns, or excuse me, owes, debt or liabilities. If you've never done this before, and maybe you're not ready quite for a template yet, the simplest thing to do is to take a piece of paper, fold it in half, hot dog style, and list everything your business owns down that left-hand side and all of the debt that your business has down the right-hand side. Every balance sheet is going to be formatted the same, having assets on the left and liabilities on the right. And we're going to go through exactly what should be listed on each side of the balance sheet. So if we think about this as a snapshot and we talk about it, what our banker is looking for when they look at this is they're looking at trends and how we've changed and how we've developed over the years. So continuing the picture analogy, it's kind of like maybe for those of us who grew up in the 80s and the 90s, my mom used to take the pictures from school and place them side by side. And some years I would get more awkward and some years I would get more attractive. And that's just the reality of being a kid, right? And some years you had to get more awkward to eventually become more attractive. So the years you got braces or something like that, or a new haircut. And that's exactly what your banker is doing, just like my mom did. They're lining up your pictures and looking for, is this business getting better? Or are we declining maybe in some areas? And what adjustments can we make to make this business a better business and less risky of a business? So that's exactly what they're doing. And so for those of you who are coming into this for the first time, that's why they're asking for multiple balance sheets and potentially multiple cash flows so that they can start to compare year after year. They're also going to take your picture and they're going to include it kind of in their portfolio of all of the other loans that they are currently servicing. So they're also using this balance sheet as kind of a measuring tool against other farms and ranches that they are currently supporting. So it's really important that we get an accurate picture of your business. So let's start and dig in. I like to prepare the balance sheet at the same time every year. So your banker might ask you to develop a balance sheet as of January 1 or as the date of your renewal. Again, work with your banker, ask them what they want. So they don't want to compare a January 1 balance sheet to a June 1 balance sheet, okay? It's just like going back to those school pictures. It's not fair to compare a picture of a kid at the beginning of the year to a kid at the end of the year, right? There's been a lot of growth and a lot of changes. In agriculture, if we hit a different point in the production cycle, it can be difficult to compare those balance sheets together. So I like to see a consistent date on the balance sheet, and my personal preference is January 1. Again, work with your banker to determine what date they want that balance sheet as of. So when we talk about dates, what's important is we're going to go back and look at the current balance and inventory of everything that business owns. So for example, I would go and say, okay, on January 1st, I had this much cash on hand for the business. We had this much in all of our checking accounts. We had this much in accounts receivable, okay? We also are going to take a current inventory, especially of prepaid expenses and supplies on hand. And this can be fun to value what that value is. If it's something that was purchased recently, that's much easier than something maybe that's sitting on the shelf that maybe we purchased a while ago and the value has changed. But we do need to inventory what we've got in the shop or in the shed or wherever it may be and add a value to it. If we're, especially if we've got a crop that we've overwintered, like a winter wheat crop, we're going to need to know what we have already invested in that growing crop, and then make sure that we've got a really good inventory of any crops in the bin and any market livestock. If we move over to the other side of the slide, we're also going to have to inventory and value breeding livestock, machinery, titled vehicles, land, and any buildings or improvements. So as we build this balance sheet, we're going to work through this process of knowing exactly what this business owns and what it's worth. And it's somewhat easy, but it's somewhat difficult. And I think if you've done it a few times, it's pretty simple to kind of hop back in. But if this is your first time, again, get to know that banker that you're working with and work with them through how they are valuing specific assets and inventories. So let's talk about value. Traditionally, there are two different ways to value assets on a balance sheet. I'm going to hit both of them, but I want to be very clear that typically it's most common to see a market value on a balance sheet. Okay, so I've seen some that show both a cost value and a market value, but if I'm looking at just a plain balance sheet, 75 to 90% of the time, it's just going to show a market value. Okay. But I do want to talk about both just in case you do have a cost balance or a cost value balance sheet. So a cost value balance sheet basically looks at the purchase price less any economic depreciation. Okay. So depreciation is basically the wear and tear of assets over time from use. Okay. And we depreciate quite a few assets, especially machinery, vehicles, buildings, and breeding livestock. Okay. And so it's really important at this point to discuss that the depreciation you're accounting for on your balance sheet might be different than the depreciation you're reporting to the IRS. So the IRS has special types of depreciation, bonus depreciation, accelerated depreciation, that allows to take advantage of that tax law that might be different than what we are using to report on our balance sheet. Typically, if I see someone with a cost value balance sheet, they're using a straight line depreciation, and I have an example of that straight line depreciation there at the bottom. And basically what it says is you're going to take that purchase price and you're going to subtract off a salvage value. So at the end of that asset's life, what is that asset estimated to be worth? And then we're going to divide that by the life of the asset. Okay. So that's cost value. Market value is somewhat more straightforward, but can be difficult. And market value says, what will a willing buyer pay for that asset? So market value says, if I took that piece of equipment and I put it on auction, what's a realistic price that I can receive for that asset? So what's interesting about this is that if you have crops in the bin or you've got market livestock ready to go, your lender is going to provide you with a price for those commodities. Okay, so they're going to, everybody in their portfolio is likely going to have the same dollars per bushel on corn or wheat or soybeans, or price per head of cattle given their weight. But the more tricky part are things like machinery, equipment, vehicles. You know, what is that really worth? And the perfect example of the difference between cost value and market value is when we look at land. So land, especially recently, has typically a very big difference between the cost value and the market value. So we want to make sure we know how our lender wants those assets valued, and we want to make sure that we provide a realistic depiction, if we're using the market value, of what a willing buyer would pay for that asset. And so it's, again, I encourage you to work with that lender, to talk to that lender about how they expect things to be valued, and if you're using a market value, where they want you to be. Typically on the market value side, a lender wants you to be a little bit more conservative because being conservative on that balance sheet is more realistic. Okay, so for example, land values, we've seen some crazy land sales recently. You're not going to want to value that land at the absolute highest, per acre sale rate that you've recently heard. You want to value it for a more realistic rate and potentially a little bit more conservatively. So providing, making sure that market value is realistic. Market values are somewhere where we can create kind of a filter, going back to our picture analogy. So again, we want that lender to be able to look at that balance sheet and recognize who we are. And so we don't want to put too heavy of a filter on our balance sheet. So if we do adjust the market values, again, I would consult with your banker prior to doing that and making sure that they're in a range that they're comfortable with on that market valuation. So take care when you value those assets. And I really like to make notes on balance sheets when we adjust those values. So I think that can be really helpful to say, this is the year that we did a review and we adjusted those values. Your banker might also potentially do an appraisal for you and come out and walk through your property and do an appraisal, especially of the equipment, etc., that you have. And that can help with adjusting maybe some of those market values. All right, so let's switch over to the other side of the sheet. So we've got all of our assets listed, we've got them valued. Now, as we move to the right side of the balance sheet, what we're going to list out basically is all of the debt that we have, okay? And I think this is usually easier for folks to do because it's pretty easy to say, I have accounts payable to these people, I have an operating note or a line of credit, I have some credit cards, and then I have maybe a mortgage or a machinery loan. So typically the list there comes together a lot easier for folks. I want to make sure that you list any accounts payable. So if you owe the neighbor $1,000 for whatever that may be, it needs to be listed. Another thing I'm seeing more of is that almost every service provider or input provider is offering some sort of line of credit, basically, 0% financing for whatever term. And so we're seeing that it's common or more common for a producer maybe to have additional lines of credit through seed, chemical, or machinery dealers. And that needs to be, your banker needs to be aware that you have additional lines of credit, especially if there's a balance on those additional lines of credit. Okay, so don't, forego listing those on your balance sheet, especially if there's a balance on them. I also occasionally see somebody forget to put their credit card on there. And again, credit cards for business purposes can be a useful tool. Make sure that they're listed, especially if there's a balance on them. When we look at the longer term loans, we're going to have to separate those loans into the payment that is due in the next year and then what's due longer than a year from now. So that can also be something that can be difficult. You've got to go find your loan documents, calculate how much you owe this year, and make sure that we know the difference between those two. So now we've got all of the information. We've got all of our assets. We've got them valued, and we're going to organize this information on our balance sheet. So again, if you're not quite ready for a computer, Excel file, you can do this just on a sheet of paper. So at the very top of that sheet, we're going to put our current assets and current liabilities. So current assets would be anything that already is cash or we expect to turn into cash within the next year. And current liabilities would be any debt payments that we need to make within the next year. Intermediate assets have a life of 1 to 10 years. This is typically machinery and breeding livestock. And then we're going to match any loans that are associated with those on the other side of the balance sheet. And then long-term is anything that has a life of greater than 10 years, which is typically land and maybe buildings. And then again, if we have a mortgage or something, we need to put that then according to the lifespan of it, right? So that is basically a balance sheet. Now we are going to subtotal each of those. So we're going to have, total current assets, total current liabilities, and then we're also going to have a complete total. So total farm assets and total farm liabilities. Okay. Now, what makes it a balance sheet? What makes it a balance sheet is that we have to know what our total assets are and what our total liabilities are. And then the difference between those two numbers is what we call net worth. Okay. So net worth says this much of the assets that we have are unencumbered by the bank. Okay. So that's the basic format for developing that balance sheet. Now, there's occasionally you might run into someone who does not separate out intermediate and long-term assets. They just call them non-current. Okay. Depends on the bank. And occasionally I'll run into, they just have current and non-current. That's perfectly fine. So just to drive in kind of what gets listed under current assets, there's a good listing there. Again, places where I see folks maybe miss out are prepaid expenses do get listed as current assets, and investments in growing crops. I think the rest of that is pretty explanatory. Again, intermediate assets include breeding livestock, machinery, and titled vehicles. And then long-term assets are land, buildings, and improvements. If we go to the liability side, current liabilities are listed there, and then intermediate is typically machinery loans, and long-term is typically land loans. All right, I've already talked about net worth, but just to drive it home, at the very bottom of that balance sheet, we're going to see the difference between the assets and the liabilities. So to calculate that out, we just subtract total liabilities from total assets. And that's basically the owner's equity in the business. If you've ever heard that term, owner's equity in the business. So we want this to be a positive number. Positive is green for go, that's good. And negative, which means we have more liabilities than we have assets in our business. So we need to look for ways to improve that net worth. Now, when somebody comes to me and says, I have a net worth of $1 million, that $1 million can be achieved in multiple ways. I might have $1 million worth of assets and absolutely no debt. Okay, and I would still have a net worth of 1 million. I could have $2 million worth of assets and $1 million worth of debt and still have $1 million in net worth. So although net worth can give us an idea of where you're at financially, know that there's multiple ways to come up with that net worth number. And so we need more information about your business to say, is that $1 million a good net worth? Or do we need to look for areas of improvement? Okay, so we have built the first document, which is that balance sheet. And really remember, it's that snapshot of your business at that point in time. And typically, again, I like to see that as of January 1st. Your banker will tell you what date they would like to see it as of. But on that day, this is exactly how my business looked. So I'm going to switch screens here for a second, and I want to show you a balance sheet template. Let me get this nice and big. This is from Michigan State University. And as you can see, it really kind of sets up in the same format. But I want to point out what's happening kind of behind the scenes here. So you can see they have current assets and current liabilities, intermediate assets and liabilities, and then they've got the long term. Okay. Now, this one also allows you to put in your personal assets and liabilities. Again, work with your banker to see if they want that. If you have some sort of entity, they may not. Okay, but if you're a sole proprietor or an LLC, they may. So I'm going to focus on the farm side of it, but they may also ask you for your personal information related to assets and liabilities. Now, just because you put it on your balance sheet does not necessarily mean that it's being used to guarantee the loan. You will have a separate document that identifies what they're using to guarantee the loans. Okay. But let's hop over here, down here on this tab that says current assets. And the reason I like this example template, and a lot of them do that, is that they have tabs across the bottom that allow you to put in information. So, you know, I can call this sock drawer cash and say, I don't know, maybe we have $500 in the sock drawer. Okay, so when I do that, it will automatically come up here and update this. So by utilizing these tabs, I'm able to make adjustments and really easily kind of go through and update my information. I can kind of do it line by line. So that is really quite useful. We're going to talk about some financial ratios that can also be calculated by our balance sheet. And this one automatically calculates some of those financial ratios on your behalf. So again, these slides will be posted online. You will have a link in that slide deck that goes directly to this example. So as you can see, we could go through and kind of list everything out. It also has places for you to identify make, model, year, serial number of machinery and equipment, and then also works through buildings and improvements as well as real estate. And I like this one as well because it has both the cost value and the market value on particularly on the land. See, we've got a question. Oh, no. If you do have questions, feel free to drop them in the chat or into the Q&A. All right, so I'm going to head back here to the PowerPoint presentation, and let's start to talk about what is your banker looking for on your balance sheet. And I think that's something that's super important. Is they don't just want this list, right? They're going to do something with it. I talked about how they're going to compare you to yourself, and they're potentially going to compare you to everyone else in their portfolio. So the way that they do that is they use 21 different calculations or ratios or measures to look at your business. And this allows them to compare across businesses and estimate basically the financial health of your business and the financial performance. Now, 21 is a lot of different calculations, and not all of them can be done off of the balance sheet. But today we're going to look at, I believe, 3 that are specific. Now, these measures are developed by the Farm Financial Standards Council, and they are standard across the U.S. and across all farms and ranches. Okay. So using the balance sheet, here's a few of the items that will be calculated. And that's the working capital, the current ratio, and the debt to asset ratio. So the first 2 ratios that we're going to look at are liquidity measures. And that basically means, does your operation have the ability to meet your financial obligations within the first year or within the next year? Okay, so we're going to look at how they calculate those. And then the third ratio we're going to look at today is a solvency measure, which says overall, are you able to pay all of the debts if your business was completely liquidated tomorrow? Okay. Now you'll notice that I don't have any measurements in the area of profitability. And that's because our balance sheet doesn't show profitability. Okay. So at this point, we're not measuring profitability. We're looking basically, can you service your debt? So let's work through working capital and current ratio first. So working capital looks at the very top of your balance sheet and says, again, can you pay all of your debt this year? Okay, so all we're going to do is we're going to take current assets minus current liabilities. Okay, so can you cash flow overall for the next calendar year? If this number is positive, you're good. Okay. If the number is negative, we need to look at making sure we've got absolutely everything accounted for, and look at our plan for the upcoming year. Maybe considering doing some restructuring of debt or refinancing of debt, to make sure that we can pay off our bills in the coming year. So that is the working capital, setup. Okay. So now let's look at the current ratio. Current ratio is a little bit different. Similar to my discussion of net worth, sometimes just a plain value doesn't tell us enough, right? So we want to look at the relationship between current assets and current liabilities. So when I look at the current ratio, what I'm looking at is expressing the same information in terms of a percentage. Okay, so this time I'm going to divide the current assets by the current liabilities. And the way that we interpret this number is, for whatever that value is, let's say it's 1.5. Okay, so for every $1.50 I have of assets, I can cover $1 of liabilities. Okay, so the ranges on this occasionally get adjusted. Basically, though, if we're above 1.1 to 1.3, we're okay. Okay, if we're less than 1.1 to 1.3, we need to have a conversation. So what's that saying is, if you only have $1.10 to $1.30 worth of assets to pay for $1 worth of liabilities, we need to consider where we're at. If you sit in kind of the middle here of 1.3 to 1.7, you're in an okay place. We want to watch where your current ratio is at, but we know that you can cover your debt for the coming year. If this ratio is greater than 1.7, we are good to go. And we might consider maybe why we have so much current assets to current liabilities. Maybe there's some opportunity to do some reinvestment in the business and those kinds of things. So again, let's review. Working capital, current assets minus current liabilities. Current ratio is current assets divided by current liabilities. And both of these are liquidity measures, asking whether or not you can complete the paying off the debt that you have due within the next year. Let's talk about debt to asset ratio. And debt to asset ratio, again, is a solvency measure, which says if everything was liquidated, if we sold all of the assets, would we be able to pay off the liabilities? So this time, we've got to be careful because we're flipping things here. We're going to take total assets divided, or excuse me, total liabilities divided by total assets. Okay, so this time we want a smaller number. Okay, smaller numbers are better. Okay. So typically, if this ratio is greater than 60%, means that you have 60% of your assets that have some sort of debt associated with them. Kind of the mid-range is between 20 and 60%. Okay, so again, depending on where you're at in that, we're okay. But we want to make sure that if we're going to take on new debt, that we're able to service that debt. And then if this is less than 20%, we're in the green. We're good to go. And again, maybe we could consider taking on some additional debt and experiencing if there's a possibility there, maybe for some expansion. So again, the last two ratios looked only at the current assets and liability. This ratio looks at the total liabilities and total assets. Okay. Now remember, this is only 3 ratios of 21 total measures. So if we are digging into these ratios and you prepared your balance sheet and you take it to your lender, being aware of maybe if these are kind of towards that red end, that we're going to make some adjustments and thinking through what we could be doing. But I think it's important to know that there is potentially a big difference between the current year versus the overall picture of your business. And they're going to be concerned about both. Okay, so how do I improve a balance sheet? And to oversimplify it, it is to increase your assets or to decrease your liabilities. And there's several different ways that we can do this. So just some ideas would be selling assets for more than they are valued on the balance sheet. So I also teach grain marketing for the University of Nebraska. And it's a great darn day when I can market grain for higher than what that corn or that bushels were valued on my balance sheet, right? Because I'm beating my bankers' expectations of what they cash flowed me at and what they estimated the value to be at. So I can use that as a place to think about marketing in. But we could also think about maybe there's some assets farther down the balance sheet that maybe we're not using as much. Maybe there's some machinery on there that we're okay with departing from, right? And we're able to sell that for a higher value than what's valued on the balance sheet, okay? Another option is to pay off debt. Okay? So thinking about ways that we can pay off that debt. So maybe we are able to sell assets for more than they're valued on the balance sheet. And instead of taking that money and buying a new asset, we're able to take it and to pay off some of that debt. Refinancing, I think refinancing can be a useful tool, especially in a few years ago when mortgage interest rates were so low. We saw a lot of producers going in and locking in those lower interest rates. And what they were doing is they're reducing the payments that are due within the next year. The other thing you can do is you can extend the length of that loan, which may or may not reduce your interest, but then reduces the amount of the principal payment and extends it, kind of elongates that loan. And so that is another option if you're looking at potentially refinancing. Delaying capital purchases. So again, maybe you have some plans that we need to replace a piece of equipment. Maybe we can extend the life of that piece of equipment and not renew it quite yet. Reducing personal withdrawals. I think this is a fine line. Maybe your business, you need to maintain those withdrawals, but it is a place where if you feel comfortable, could be a place where you can do that. And then I've talked about maybe selling off unprofitable or unnecessary assets, or finding ways to use those assets more efficiently, such as custom farming. Now, it's important as we maybe discuss some of these things that we have to think about their implications beyond the balance sheet. We have to think about potentially the tax implications and logistics to make some of these things work. So don't think about this in just the vacuum of your balance sheet. If you're looking to improve it, make sure you're considering multiple facets of what would happen if you needed to improve your balance sheet with some of these items. Okay, I saw a question in the chat. Let me pull that back up. The question is, I put a deposit down when I ordered a pivot. Is that prepaid? When you ordered it, I'm going to assume that you're going to be taking a loan on that pivot. And so that loan would be listed down on the liability side, and the loan would already account for that deposit. Now, if you don't have a loan, I think I would work with a banker to see how they want that handled. I'm not sure. I'm just gonna be completely honest. I'm not exactly sure, but I'm gonna assume it's a part of a loan. And so if you have committed to that loan, then you would have that reflected simply as the loan on the liability side, and then would have the pivot listed as an asset then on the left hand side in that on your balance sheet. So again, if you have any questions, please make sure you put them in the chat or in the Q&A. All right, let's talk about cash flow budgets. So cash flow A cash flow is the second document that you are going to provide to your banker, and we're going to budget out for the next year what we expect to spend. Okay, so it's a spending plan, and your banker might ask you just for an annual cash flow. What do you expect to have as income? What do you expect to have as expenses? However, I prefer that you prepare this either on a quarterly or monthly basis, because in agriculture, we have very few paychecks throughout the year, but we're paying expenses all year long. So I think this is something that we need to be cognizant of, and the fact that there are going to potentially be periods where we're going to need to use that operating note. And when you are in your loan renewal meeting, inevitably the lender is going to say, so how much money do you want this year? And it's a lot easier to have a monthly cash flow budget and say, this is kind of what I estimate I'm going to be short during specific periods of time. So what we're going to do is we're going to estimate that monthly income and expense by line. Okay, and what I mean by line is I'm going to estimate how much grain I'm going to sell, how much livestock I'm going to sell, how much custom hire work I'm going to do. Okay. And again, remember, the bank is potentially going to provide you with a commodity price for bushels or for head of market livestock. Okay. So again, just knowing I'm potentially going to sell, 5,000 bushels at X price, they're going to tell you what that potential price is. Okay. On the expense side, we're going to go through the same process, item by item, and say, we're going to pay this much in rent or chemical or insurance. And I think it's important to really think through exactly what you expect to spend for the coming year. So what this allows us to do, if we do this on a monthly basis, is to, again, identify how large of an operating note or line of credit that we need for the coming year. If I just do it on an annual basis, I'm not seeing that variability of income and expenses. So if you're doing this for the first time, there's a couple different places you can look. And I would encourage you to check out the University of Nebraska's crop budgets, as well as the University of Minnesota's FinBin. If you've done this before, you can look back at previous spending, and that's a really good place to start to kind of figure out the timing of, this is when I typically pay rent, this is when we typically sell grain or calves. And it's important to make sure you make adjustments based on the acreages, expected bushels, those kinds of things. So don't just pull down last year's monthly spending report and say, this is what it's going to be. Make sure okay, we're going to maybe swap out corn acres for soybean acres, and this is kind of the differences in that cost of production and those prices. Or maybe we've liquidated a few cows, that means we're going to have fewer cows on the ground. Okay. Make sure you don't double count any prepaid expenses. Okay, if you've already paid those expenses, they're not going to show up on your cash flow budget, right? Because that money has already departed the bank account there. And also don't forget any overhead expenses, including utilities, insurance, labor, that might not be directly associated with a specific crop, but is still associated with your business as a whole. So I do want to take just a second, and I'm going to show the crop budgets. New share here. So we have already released the University of Nebraska crop budgets, and you can either see them in a PDF or in an Excel file, or you can check out our new ag budget calculator that will allow you to look at what expenses are and kind of do some estimations. I believe the ag budget calculator does have a cash flow module built into it, and we will be doing some trainings on utilizing the cash flow module as well. I'm going to stop that share real fast, and I am also going to show you the FinBin information. The University of Minnesota does some reporting of financial information of farms and ranches across the country. And so you can see information at this FinBin website. One of the things I like to look at is looking at the differences in expenses. So maybe you're looking at a new operation, or you're curious about, especially livestock. You know, what are people really paying per unit for something? So I'm going to move this up to let's do cow-calf and all states. And right now the 2022 data isn't in yet. It will be soon. But basically, what this does is kind of looks at what they paid per cow for things like hired labor, insurance, feed. And so you can kind of compare yourself to these other folks and say, okay, if we expand our cow herd, maybe what would those costs be? Or if this is the first time I'm looking at it, what would those costs be? So again, those two resources are awesome places to find information. Also, again, I sound a little bit like a broken record, but also working with potentially your banker to say, you know, what's a realistic veterinarian cost for my size of operation? All right, and Ryan has put those links there in the chat for you so that you can directly work with those. And again, the slides will be placed online so you can check those out with the recording. So I'm going to work through putting together a cash flow budget. Okay, so what we're going to do is we are going to start by building out what our beginning cash balance is. And then if we already have a loan balance, we're also going to have to enter that. So as I move down here, we're gonna make sure that we get those right from the beginning. Okay. Then I'm going to put in the estimates for what my income and expenses are on a monthly basis. On your screen, I just have them kind of lumped together, but your banker's probably gonna want to see, well, what is that, you know, $3,500. Okay, so they're going to want line by line, whatever that happens to be. And then on the outflow side, same thing. They're going to want to know, is it fertilizer? Is it chemical? Is it repairs? What do you expect to spend each month? So as we move down here, so I'm going to take that beginning cash balance. I'm going to add in any cash inflows for the month. I'm going to subtract off the outflows. Okay. In the month of January, in this example, this farm and ranch actually has a positive value here. So they're not going to tap into that loan balance at all. Now, we got to make sure we carry forward. Okay, so we're going to carry forward those balances again. So the ending cash balance and the ending loan balance, we're going to carry forward to the next month and repeat the process of estimating by line those income and expenses. So you can see that our cash outflows exceeded our cash inflows, but right now what this farm is doing is kind of burning through basically some cash that they had on hand. Okay, and then we repeat the process again. Now in March, we finally hit a point where we have burned through all of our cash, and now we're going to start to tap into that operating note or that line of credit. So they were short $40,500. So that is going to transfer down here, and we're going to borrow that amount from our operating loan. And we don't have any cash to pay any of that off. So now we have a ending loan balance and a zero cash balance. Okay. So then we can move forward, and this is the exact same setup we saw in March. Okay. As we move forward, we're going to experience something similar in April. Okay. And again, we have exceeded our cash outflows, have exceeded our income for the month. So we're going to add an additional $54,500 to our balance. Okay. So now we have an ending loan balance of $95,000, and we still have zero cash. Finally, in the month of May, we start to sell, and we're able to generate more income than expenses. But typically when we're working with an operating loan, if we have any positive cash flows like we do during this month, then we're going to use that to pay off the operating loan. Okay. So as you work through this, remember that if you have any positive cash flows and you have a loan balance, you're going to pay off that operating note first. Okay. So when that banker leans across the desk and says, okay, how much do you think you need this year? You're going to look at the greatest estimate loan need. So for this farming operation, it was $95,000. They're probably going to ask for a slightly larger amount than that because this is estimates and things can change. And that's how they're going to kind of look through the loan. Now, one thing you can do that would be probably pretty helpful for your banker is to email your balance sheet and your cash flow to them early, so that they can kind of spend some time reviewing what you've done. It's hard to sit down and try to look at something kind of cold. And so giving them that opportunity to maybe study what you have put together and kind of think through, is that reasonable? Is it not? They also might ask you to come back in after you've provided those documents. So especially if it's a first time or it's significantly larger than you've had in the past, be prepared that they are going to need some time to digest the information that you're providing them. So when we talk about improving or reducing operating loan needs, one of the things we can do is we can align the income with the expenses. So in this operation, they didn't have basically any sales January through March. So maybe they can do some sales earlier in the year to reduce the amount of money that they're borrowing from that operating loan. The other thing they could do is potentially look at, is there an opportunity to spread out some of those payments, make smaller payments or shift those payments maybe later in the year. And then reducing principal payments can also help improve that operating note. And again, that could be through refinancing. So my last comment on cash flow documents are that cash flow makes your business go. Okay, it's the lifeblood of your business. And without cash flow, you don't have a business. So we need to look for those opportunities to have cash flow and working with that lender to make sure that we've got the right amount of operating note availability so that we can make that business operate. I just want to reiterate one more time as we kind of wrap up this afternoon, is that neither the balance sheet or the cash flow show profitability. I'm going to say it one more time. Neither the balance sheet or the cash flow show profitability. Okay. This is showing whether or not you can service your debt within the coming year and how large of an operating note you need to get through those periods where our income and our expenses are not aligned. Okay. So the only way that we show profitability is with a true accrual adjusted income statement. And unfortunately, that's kind of beyond today's discussion, but it is one of those financial documents that if you're working with a lender, they can help you develop. So with that, I'm going to open the floor for any questions. Again, my contact information is on the slides, and you will be able to receive a recording of this webinar as well as the links probably within the next 24 hours, give or take. And you're always welcome to reach out to me or any of my colleagues at the Center for Ag Profitability. So with that, I'm going to encourage you, if you have any questions, to place them in the chat.
Yeah, thanks, Jessica. And while people are thinking about putting their questions in, I'll just take a moment to encourage you to join us again next Thursday for our next webinar on January 12th. We'll be looking at beef heifer replacement price forecast for 2023. And then coming up at the end of the month, January 26th, we'll be joined by some folks working with on-farm research here at UNL. So looking forward to those two webinars, and you can find those on our website. Register at cap.unl.edu/webinars. And that's where you'll also find the recording of today's webinar, along with the files, as Jessica mentioned. That should be up by tomorrow afternoon, if not later today. And we usually have a survey for you to fill out. We always appreciate your feedback, but our survey platform seems to be down today, so I can't get into it, but perhaps I'll follow up in an email. But once again, last call here for questions. If you have them for Jessica, she's a great resource here. If you have anything at all that you're wondering about that she presented on in terms of preparing to renew your loan this year, now's the time.
So Ryan, I did forget to share the cash flow budget template. So let me go ahead and do that while we're waiting for any questions to roll in. This one is from Iowa State University. It's a nice document. This one does it every 2 months, but it has a nice format where it has both crops and livestock, and allows you to have a opportunity to kind of think through those individually. And this is what I mean by listing things out by line. So you can see, you know, how many acres, how much yield, and then being able to determine basically how much expense there. So there's a question in the chat about what your loans are secured by, and you will work with your banker to know what exactly each loan is secured by. And there's a separate document that will list out when you do your signatures, that lists exactly what loans are secured by what assets.
All right, well, that looks to be it for the questions. Since we're at the end of the hour here, Jessica, thank you very much for presenting great info again today. And once again, don't forget to look for the recording of today's webinar at our website on the Center for Ag Profitability at cap.unl.edu. Again, we'll be back next week with a look at beef heifer replacement price forecasts for this year. So with that, Jessica, thank you again, and I hope everybody has a great rest of your Thursday.
Thanks, Ryan.